Pleasure to be here tonight. I want to thank everyone for taking time out of their busy schedule to show up and listen to me talk about potentially the world's most boring subject. So first of all, before I start, big shout out to Nanaimo. I know there's a group party and a pizza watching expedition going on. That's great. Couple things tonight. Number one is I'm here to entertain you. And the reason I'm here to entertain you, oh, that's better, is because this stuff can be boring. So I'm going to go between being boring and kind of being interesting and telling you guys stories and anecdotes about my experience being on both sides of this. Two is I'm here for you. So my goal here is to talk a little bit, but also to listen to any questions that you guys have. So I want to leave at least half an hour, maybe 45 minutes for a segment that I call Startup Confidential, where you show up and you ask me questions and I try to answer them. So a couple of words of wisdom before we start and some warnings. So number one is I'm going to swear this evening. So if someone is not comfortable with me swearing, they should leave. I might talk about the existence of sex and I might use some bar references. So just so if anyone doesn't feel comfortable with that, if that's not cool, you can leave now. Okay, cool. Let's talk about capital planning. So first quick intro on me. Number one is I have a competition with my identical twin brother to see who has more Twitter followers. Tonight I'm going to gain about 50 or so, so that's my handle right there. You can follow me, you can send great tweets out, I will retweet, we will become tweeting friends. Excellent. I will not answer a question you ask me unless you're my Twitter follower. I'm just kidding. Wow, that's a lively crew. Okay, cool, here we go. How many of you guys think you're gonna win the New Ventures BC competition? Put your hand up. Sweet. How many entrepreneurs do we have in the room? Put your hand up. Wow, that's good. How many service people looking to get money from the entrepreneurs? Wow, that's impressive. There's one? Was there one? Okay, there's two. Awesome. And you're videotaping this. That's fantastic. Okay, sweet. That's good. Okay, so let me tell you about myself super fast. I am a serial entrepreneur. I have started and sold 2 companies to 2 public companies. The last one was in 2013. I have 3 young children, which I'm going to talk about more later, and my goal is to live a happy, carefree life. So I chose not to go back into the realm of being an entrepreneur and fighting and scrapping it out. I now invest money, which I didn't ask the question. Are there any investors in the room? Awesome. Okay, so I can make fun of investors the entire evening. That's fantastic. So I took about a year off in 2013 after I sold my last business. I traveled with my family to multiple places, and then I got a bit bored and I started doing some angel investing. And I'm a very analytical guy, and so I realized that I sucked at angel investing. I wasn't very good at it, so I needed to learn. So what I did is I joined 2 organizations as an EIR, BCTIA and what was called Grow Lab at the time. And for some reason, within 20 minutes, I was made the executive director of Grow Lab. And in the last 18 months, I've made about 18 investments. So one side of the equation, I've started 2 companies. I have about 15 years of experience building those companies up, financing them and selling them. And then in the last 18 months, I've done 18 deals. And then I started something called a foundry. So I have, basically the foundry is the notion that we create companies, we bring entrepreneurs, we bring our ideas and we fund them. And we have 3 companies in our portfolio, which are the 3 at the top. You can check them out. There's actually another one that just launched about an hour ago called Blue Mesa Health. So we have 4 companies in our portfolio. So I'm not only an active angel investor, I create companies and entrepreneur. And the last thing I'll say is I've just, and this is probably not announced yet, but now it's on the interweb, so it is announced. I'm running a syndicate out of AngelList. So I am running Canada's #1 AngelList syndicate. It is called Flight.vc, and it is run by myself, my brother, business partner Mike, and a fellow by the name of Gil Penchina, who is the #1 angel investor likely in the world right now. So we're running a syndicate. We are investing in deals. So I am investing. I invest actively. I'm doing that right now. And so the goal of this presentation is to tell you a little bit about sitting on both sides of the equation of both investing and getting invested in. So a couple of thoughts as I go through it. One is that some of this first stuff is pretty content heavy, so I'm going to sprinkle in some anecdotes. Some of this stuff I am assuming as we start this process, and I've done this a couple times now, you guys are starting pretty basic. So for some of you in this room, this will be potentially more boring at the start and potentially more interesting later on. For those people in the room that don't know anything, this will be potentially the best 2 hours that you ever spend, potentially for the rest of your life. That's possible. Okay, potentially. Okay, so let's go through the agenda. So I want to talk some overall themes. First of all, I want to talk about some pet peeves and things that I've seen. 2 is I want to talk about the details of the deal. What does a deal look like? And how should I be thinking about my deal in my early nascent startup? I want to talk about an entrepreneur's perspective on a deal. What do you guys want, or what should you want out of the deal? And then I also want to talk about the investor's perspective. So I want to play both sides. I want to say, here's what you guys want, but hey, here's what I want. And then finally, questions. And then one thing I'll say is I'd love to have questions sprinkled throughout, because I just don't want to hear the sound of my own voice for an hour. We are going to take a break, and I think that's the only other thing to say. Any questions so far with the introduction and the agenda? Would anyone like to break the ice? No. Okay, let's move on. This is my first swear word of the night. I am going to caution all of you that you don't want to be an asshole in business. And so this is something that I think is really, really important. And it's something that I think more and more investors are taking to heart. And it's something you need to look out for when you talk to investors. If an investor is being an asshole in a meeting, not making time, leaving, not interested in what you're saying, why would you want to be in business with that person? So one of the things I really focus on in life is short. Don't hang out with assholes. Don't take money from them. Don't invest in them. And don't be business partners with them. So I'm going to take a moment. Everyone think to themselves how many of these kind of people you know, and stop the madness. Don't accept it. Don't do business with assholes. That's going to be my #1 theme that I will discuss tonight. And I think that's a great picture for it. Number 2, and this is really important as it relates to New Ventures BC and anything else that you guys do in your startup, you got to decide what you are. Are you a big company? Are you a company that wants to go big, take a big risk and get a big reward? Or, which is what all of the literature and the conversation is leading you to, right? All of that like tough guy, go big or go home mentality that we all talk about with startups is really kind of saying if you're not really ready to go big or go home, you're a loser. Okay, so I want to have this discussion first off tonight because I don't think you're a loser at all. Some of the best businesses I know are lifestyle businesses, but what that means is that don't play the game that everyone else is playing. Don't go raise money if you're a lifestyle business. If you're in a small market, don't raise money. If you don't want to lose control, don't raise money. I'm going to stand here today and say of the 60 or 70 people here today, probably only 5 of you will raise money. I'm sorry to burst of any significance, right? So the stats are you're all sitting here on a lifestyle company, and it's the exception rather than the rule which will get the funding. I'm going to talk about some of those exceptions and what I would look for as an angel investor, but I just don't want you to think you're a loser if A, you can't raise money, and B, well, no one wants to give it to you. No one will give it to you for some very good reasons, which we're going to talk about. So I really want you to focus on what kind of company you are, and that is predicated on a number of things. So the other thing I really want to focus tonight is this magic word called valuation. So what the hell is my company worth? And I'm going to say something flippant, which I'm going to come back to, which is worth as much as someone's willing to pay for it. It's very, very simple. And so you can spend all of this time and machinations around building comparables and models and all of this crap, but ultimately it's going to be if you can't fund this company yourself, you're going to have to find outside funding to do so. And to find outside funding, that funding dictates the terms, right? Unless you create such greed, unless you get so many people pregnant with the notion that your deal is the best thing the world has ever seen, you are going to take the terms of the lead investor putting the most money in, and I'm going to talk tonight about some of those terms that you should worry about and some that you shouldn't. The other thing I'm going to talk about with Capital Planning 101 is don't start planning out what happens 5 years from now. So this notion, and this was when I first started my first business in 2002 or 2001, this notion of 5-year projections and like what trade show am I going to go to in New York in 2022 is just a complete waste of your time. And if there's a venture capitalist that wants to know that, just politely thank them for their time and walk away, because that's not the world that we live in anymore. general trajectory of revenue, general trajectory of market size and attainable market size. That's interesting. What you do with your trade show budget or your advertising in 2022 is not. So we spend too much time early on in the capital planning of our business thinking about that stuff, and I really, really want to encourage you to not. And that might go against a bunch of wisdom. The other thing I'm going to say as I start this is every advisor is going to give you different information. There's this concept called investor whiplash or advisor whiplash. I'm going to give you my opinion with my expertise and my experience, and I don't really care if you take it or not, and I'm not offended if you don't. So I just want to say that as well. I say that in every meeting. What you do want to care about more than valuation is terms. And what we're going to talk about tonight are some of the terms that are going to bite you in the ass as you go to Series B or Series A, institutional seed, Series B, and onwards. The reality is that venture capitalists specifically and savvy angels are going to be better at this game than you are. That's what they do for a living. So you need to understand those parameters so that you can negotiate what I will give you as the most important pieces that you need to think about as you go through. The biggest things that impact valuation are the following. And this is stuff that, some of this stuff you guys can manufacture and some of you can. So number one is team. So the first thing we look for as venture capitalists or angel investors, or even as a co-founder of a business, is how strong is your team? What's the domain expertise? Are you guys good at what you do? Are you hustlers? Are you unique, passionate individuals? If you do not have a good team, start to look at that, very critically now. Because the number one reason why I don't invest in companies is because of the team. Number one, I'll give you number two in a second. But number one is the team just isn't good enough. I don't feel confident that through the 5 pivots and the 5 years that I'm going to be business partners with you, that you're going to get it done. And why? Because I rarely see teams that can get it done. Teams disintegrate. Teams start bickering. Teams don't like each other. Teams stop talking to each other, and there goes the business. And we're probably all in this room, or some of us are in the room, are in the honeymoon phase. And that's awesome. Honeymoon is great. The reason this picture is here is because what I'm looking for is a team that's gone through hard stuff. I want a team that's gone on an expedition together, failed, fell off the mountain, and is ready to get back up and do it again. They've spent a week coding for, hitting a deliverable, and they did it, or they didn't, and they're still together. It's like a marriage. It's going to be tough. Can you actually get through that process? So number one, we can talk capital planning till we get blue in the face. If your team sucks, you're toast. 2, and this is the one that we in Canada suck at. Can you tell a good story? Are you focused on the details? Are you, focused on we are incorporated? We have done this, we have done that. What's the story? Why am I going to get excited? And I was talking to a group just before coming here. We were sort of talking about, you have to understand who your target market is. I'm assuming, and I'm going to actually ask the question, do any of you guys have venture funding? I assume not. Okay. So given that none of you had venture funding, you guys are all in the early seed stage angel world, right? So as someone who understands this world pretty well and understands the motivation, you have to understand, and I'm going to use a male term because most of the investors you're going to meet are male. The goal here is 2 or 3-fold, and it's all associated with ego. The reason angels play is because they want to go to their peers on the golf course at Capilano or at Shaughnessy, say, did you get into that deal? Because I did. And by the way, Boris Wertz got into it too. You dummy, you missed it. You missed the deal. They want to go home to their wife, and they want to say, my dear, this deal's changing the world, and look how great I am that I met with these guys. I feel like I can support these whippersnappers, and let's go, let's put some of our capital into this deal. This is not generally very rational, okay? So if you look at the stats, the Kauffman Institute has done some great studies about angel returns, and for angels, especially angels that only throw around, 5 deals, 10 deals, their stats on returning that capital are abysmal. They're not doing it for that reason. If they were doing it for a return of capital, they would put their money under their bed, frankly, rather than invest in you guys, right? So the reason they do it is because Ryan at Hootsuite has a killer company, and Jeff at BuildDirect, look what they did, and look what Shopify's doing, right? what we don't realize is that's, of the numbers in this room, we could times this group by 1,000 in Canada, and we might find one Ryan here. We might find one Jeff here. You're statistically very unlikely to be that person. Now, we all think we're going to be that person, and that's the only way that we can do this job as entrepreneurs. But the reality is that angels cannot be rational because their return profile and their risk profile is just simply not rational. So there are some angels that have made lots of money, very lucky. 95% of them have broken even, made a 1.2x, or lost a considerable amount of money. So you need to tell them a story. You need to differentiate yourself from all the other people coming to them and hook them from an emotional perspective. And if you miss that, you're done. If you don't hook me or hook another angel in the first 20 seconds of your pitch or the conversation you're having, I'm just phasing you out and I'm going to check my phone. And once I do that, it's game over. So that's another thing. If you start seeing a VC or an angel checking their phone, you better start dancing on the table and doing something very extreme. So we need to tell a really good story. The final thing, which is a building block of any business, which is going to be the number 2 reason that you won't raise money, and I'm being negative to start, I'll pump you guys up later, and then I'll bring you down at the end, is how big is your market? So there are so many people that talk about the fact that my market is massive, and the reality is that it's just not. Your total addressable market is big, your serviceable market for your business is small. And if your serviceable market is not really, really big, and we can go through the details of what that is, I'm just not, you might be the best team, your valuation might be awesome, you might tell an awesome story, I'm not interested. And I'm not interested because my risk profile is I'm taking high risk for high return. So I am not going to take a risk into a company with a $10 million addressable market. I'm not going to take a risk for a $100 million addressable market. I'm just not, because the stats would say, A, you're not going to hit it, and B, if you do hit it, you might be a $10 million a year company, and that doesn't pay off all of those. I made 18 bets. 16 of them aren't going to do well. 2 of them might. So I can't play the game that you're my conservative bet. My conservative bet is Procter & Gamble and Coke and Bank of America. That's where I put my conservative money. This is not conservative money. So I think one of the things you really, really need to understand is that market, and most importantly, your serviceable market, not the total addressable market. One more thing, which separates, and this is going to be your first quiz of the night, which is how many of you guys have traction? Put your hand up. Okay, and I'm going to ask the brave souls who put their hand up to describe to me with a microphone for 20 seconds what you mean by traction. What traction do you have?
Multiple months of 20% month-over-month growth.
Fantastic. Okay, and how many, is that free users? Free? Is it a free system?
That's the total number of users, but we're a freemium play.
Okay, who else has traction? Brave soul, put your hand up and grab the mic and tell us what that means.
Half of our customers this month are repeat purchasers.
Great. So what I'm not going to do is put you on the spot and ask you any specific numbers, because you might have had 1 last month and 2 this month, and the same thing here. But what's really instructive about that, and thank you, brave souls, is that most of you guys have no traction, right? And most of you are maybe idea phase, right? And this is an early stage competition, so that's not a negative, but the differentiation between those who have traction and those who don't is what puts these deals over the edge. So I think one of the things that I would strongly encourage you to do as you go through this competition and as you build your business is build as much traction early as you can. Every business is going to have a different type of traction that needs to be built. If you are a SaaS business, a freemium SaaS business, I want to see month-over-month user growth, I want to see paid, I want to see churn, and there's a whole number of things. If you are an enterprise business, I want to see a pipeline, I want to see paid customers, I want to see maintenance revenue or maintenance SaaS revenue. And all of those things are what is going to get you over the hump with these investors. So if you don't have traction today, you should be a bit scared and paranoid and say, why don't I have traction? And ask yourself the honest question and say, what do I need to do to get traction, and do it quickly. Because if you spend a year going out and raising money with no traction, you're going to have a hard slog. Okay, now I'm going to get into some more detailed stuff, and then we're going to take a break. So number one, And I hate these kind of slides because you're going to read and you can read faster than I can speak. But I did it this way for a reason. So what do you guys want? What is your motivation in asking someone like me for money? I think the most obvious one is you want money, right? That's kind of a no-brainer. You want, or at least you're going to tell me that you want value add. You want someone who can sell your deal up. And what that means is you want someone who has enough juice, enough experience to say, I'm not the last investor in your business. I need to get Excel partners or Ping Li from Excel involved in your deal because that helps me and that helps you. You want someone who has connections and has a history of selling deals up to that next level. Because if you don't, and you don't have an advocate who is connected, you're in trouble. So great advocates in town. Boris Wirtz, obviously. Lance Tracy, incredible. Paul Geyer, if you're watching, I love you. The reality is those guys have this touch where if they touch a deal, the VCs look and say, whoa, Paul, Adam Laurent's a great example, someone who spoke last time. Adam's in the deal. John Seminario's in the deal. Paul Geyer's in the deal. Boris is in the deal. Hopefully I'm part of that conversation. I'm a bit younger than they are. But that's really, really helpful to you. So you can go to an angel forum and you can get a PwC, ex-PwC partner who puts money into 2 or 3 deals a year, and you need to ask them questions like, who do you syndicate your deals with? Who do you sell your deals up to? Because if you have requirements for more money than just this round, and this comes into the planning side, you need to get investors that can help you get to that next step, and investors that have the vision to do so and the connections to do so. So that's what selling the deal up means. You don't want someone who destroys value. This comes back to the asshole conversation, but don't get someone in play who is going to tell you what to do, who's going to be your boss, who has aspirations to be the CEO of your business. That's just bad. That's a bad start to the relationship. Don't get someone in the business who's giving you $20,000 so you give them $150,000 consulting project. Don't get someone in the business who wants to be your VP marketing and they think that $10,000 buys that position. Try to create an environment where you're not destroying value, you're actually building value. And then things are going to get tough. So the question that you need to ask yourself is, if I was in a desert island, could I survive with this person for a week? That's the question I ask myself. Can you survive on a desert island for a week? If that person you get annoyed with after an hour lunch, or you put off the coffee because they're just weird and annoying, that's a great sign to not take their money. Because when things get tough, people are gonna get weirder and more onerous than they are today. So on the one hand, you're desperate, you need the money. On the other hand, you need to think a little bit ahead and look for some of those red flags because ultimately I've seen too many deals die because the guy under duress throws you under the bus and your company dies. So don't destroy value and find someone you can be compatible with. Now, that's what you're looking for. You might be looking for more than that. We can talk about that later. What do I want? Number one is a big return on my money. I want and I'm going to go to number 3 because I talked about it already. I want an ego boost. I want to make myself feel really important in town because I'm cool and I'm throwing lots of money around and man, I'm rich and maybe I can give you a ride in my sports car. And maybe we'll play golf together at Capilano one day. So I want to make myself feel important. And don't underestimate the power of that as it relates to raising funds in any town. Silicon Valley is the most egregious there. Vancouver's not that different. So the reason you raise money from angels is because they want to feel good about themselves. It fills a hole, it fills a need, or it's philanthropy. I want to give back because when I started, this guy put money into me. So there's a couple motivations. Angel investors might want potential protection. So we're going to go through some of the details on that when we get into the really boring part of the presentation. But potential protection means I kind of want to be protected if things go sideways. I'm not really willing to take all the risk. I want all the upside. I don't want all the risk. An angel wants honest updates. And this is one of the mistakes that so many early stage companies do, which is they sell their angels. They spin their angels. Don't do that. Don't spin your angels because when things get tough, they are going to fall away when they feel like they've been spun. I, as an angel, and most savvy angels, want more of the piece. I want a pro rata share of your company if things go well. The reason I invest in 18 companies is because I'm going to double down on 3 or 4 of them. And I want optionality. The reason we're early stage investors is we want options. I'm buying cheap options. So don't play games with that. Don't cram these people down when you need more money. They were the ones who got you there in the first place. Don't put terms in there, and we'll talk about some of them, which will make them, not get their full pro rata or make it a board decision. Give them the right to take their pro rata. They also want a partner when things get tough. So the reason that they're going to like you is because they believe in you as a person. So we'll talk a little bit about what I think some tricks are around that. But this is a very human relationship. And we're going to talk about that more as it gets to the venture capital round, which is the next slide. But this is a human relationship. Just like the question you ask, could you stay on a desert island with this person? They're going to ask the same question. And if your values don't line up, if your perspective on life doesn't line up, most angels will feel that and they're not going to invest. And that's just personal. So in other words, this is personal. What does a VC want? So what is a VC? A VC is a group of money managers on the farthest end or one of the farthest ends of the risk profile. So these are professionals. These guys have egos, but they are doing it to return a significant amount of money to their limited partners so that they can get paid carry. Okay, so carry essentially is I'll do the math really quickly so you understand. There is a $100 million fund, okay? That $100 million fund has to pay management fees to the general partners. So that $100 million fund over the course of 5 years pays, say, 2.5%, $2.5 million out in management fees, okay? That pays the VC a reasonable rate, and I'll give you a number, 150 to 180 in Canada, 3, 4, 5 in the US, okay? So these guys are not getting fat on their salary. And that's the goal of the LP, keep them hungry, right? So I have $2.5 to $3 million coming in the kitty. I need to deploy that capital, and I need to return what's called a hurdle rate plus my management fees. So bear with me on the math. We talked about $2.5 million, right? So I actually deployed 97.5. Is everyone with me? Yeah? I got to return that $2.5 million that I took as management fees plus 8% before I see a dime more than my salary. Is everyone with me on that? Okay. The important part of that math is when I hit that number, I get 20% of every dollar above it. Okay? So think about that for a second. If I return $200 million on the $100 million, right? I am making essentially, and I'm rounding up, $20 million between 2 or 3 partners. That's how those guys get rich, okay? If I lose the money, what happens? Nothing. I don't have to pay it back. It's risk capital, right? The whole notion of this is it's risky. So what incentive do I have as a venture capitalist? My incentive is 2 things. I want to raise my next fund, which means I can't be a total idiot with your money, but I need to go and shoot for the fences. I will play a big game because my incentive structure as a venture capitalist is 100% tied to that big game. So I need to play the big game, okay? And couple that with the fact that 8 out of 10 investments fail. So not only does your big deal have to pay off up to that hurdle rate to get me to the carry, you got to pay for all those 8 deals that sucked for me to actually give the money back to the LPs and get my money on top. So we think about angels wanting a big return. Venture capitalists will 100% focus on your market because their return has to be big. Structurally, you could do the math you probably have in your head. If they don't return on paper a 10, 20, 30x for some of these winning deals, they don't pay their money back, and they spend 5 years making $150,000 with a Harvard MBA. That sucks, right? Those Harvard MBAs want to make $5 million a year, and many in the Valley do, and few up here do. So they want a very big return on money. So when you're playing the VC game, you're not there yet, but I want to give you sort of the horizon. You are going to play a big boy and girl game. The next conversation is these guys will out-lawyer you and out-protect anything you can possibly do. They will get almost full protection for their money. So what does that mean? And we're going to go into different types of shares. They get all of their money out first before you ever see a penny. Pref share. They might, if they think your valuation's high, they might put a little bit of ratchets or anti-dilution clauses in there, right? So I think I'm paying too much. I want to ratchet. So if the next round's lower, I get to win and you lose. Be really careful when dealing with the VC. They are professionals. They are better at this. They've done it for many, many years, and they will destroy you on the downside. You are dead. If you raise money from a VC and you don't do well, you're dead. So the only way you'll raise money from a VC is if you have a big market and likely you're doing well, but just be very wary of the protection that those guys are looking for. VCs want to reduce risk, and there's different stages of venture capitals, right? There's early stage guys. There's more and more guys like Boris or Matt Golden, Real Ventures. Yaletown was doing a little bit of this, where we're willing to throw $300K into your seed round so that we get to know you, we track your story, and we can put money in later. Most VCs, though, especially the ones in the Valley, are going to try to reduce risk from the team perspective first. If you're out of Google, your partner's out of Facebook, and you're starting something related, awesome. I'll give you $10 million. I'm Andreessen. No problem. Let's go. But what most of VCs do, and you're seeing this more and more, is the larger rounds later. So if you look at Canadian success stories like BuildDirect, Hootsuite, Shopify, those companies are raising tens, 50s of millions of dollars by these later stage VCs. We can get into the details of why that is. VCs want a great story. So that story on the VC side has to be so good because those guys see an average of 1,000 deals a partner a year. So unlike angels who might go to an angel forum every quarter, get some calls, get some coffees, all these guys do is take meetings. That's it. 5 meetings a day, every single day. So they are so jaded and so negative that you have to literally be able to do a triple backflip to impress them. It's just hard to do. They also want a very codified ability to get a lot more if it goes well. Their model on getting to that hurdle rate and getting their carry is exactly what I described earlier. 10 deals, they go big on 2 or 3 of them. They watch you work. The best VCs shoot 7 in the head, kill them, and invest hard in 3 of them. So you need to understand their math to be able to understand whether you want to take that risk. They also want a partner who is there when things get tough. I'm going to stop there for a second. Any questions about what entrepreneurs want, what angels want, what VCs want before I move on? Yes, question right there. Just a sec. We have to do the microphone for the Nanaimo pizza party. Okay.
So what happens with the 7 when you say the VCs shoot them and kill them? What happens to those companies? They just go belly up?
They're dead. Oh yeah, shoot it, kill it, kill it. Dead. Yeah. Well, and think about it, right? So let me give you one anecdote there, right? They're on the boards of these companies. So they have liability. All board members have liability, severance liability, and other liabilities personally. These guys don't want those liabilities. They drop off the board and they kill it. So killing it means I'm not putting more money in. I might stop others from doing it. You're done. Or most commonly, I'm not putting more money in, and you go ahead, and if you find a lead, you do it, maybe. But if it's really dilutive to me, maybe I'll just say no. That's where it gets nasty. Yes?
Jonathan, this is the same question, but now you answer some of these. So that means they cannot go to the second VC, perhaps.
They can't, or you can't?
Assuming I'm an entrepreneur,
yeah,
already in a situation. I know a company is very big now.
Yeah.
Is that in my businesses?
Yeah.
Similar stage, we want to be partner with them, but I worry their size is not big enough. The company only has a $1 billion invested everywhere.
Yeah.
And this is the one company they invested in. To me, this is a tiny little bit of money in this industry.
Yes.
And if I bet on that partnership with them, I feel very dangerous. Mm-hmm. So I rather bet with a big guy like Microsoft I used to be work with. Mm-hmm. Even they're a bad guy. And relatively, if I can survive, I survive. Right. So my question is that company, if they somehow didn't deliver the sales target.
Yes.
And they will kill him. And once kill him, being partner of that one, I'm in very dangerous situation.
Right. So I think I understand the question. Let me give you an answer and see if this answers, and you can tell me if it does. So I think one of the reasons why you get into trouble on the company side in this scenario, right? Company doesn't hit sales targets. The VC who led your last round is not participating. The problem is it's a super small world. So I'm at Excel, and I need to, so I'm at Excel, and I'm going to pick on Excel for tonight. Excel is in your deal. Excel won't put more money in. Sequoia comes to the table because you're a hustling entrepreneur, and you bring some guy from Sequoia to the deal. What does the Sequoia guy do? He calls up Excel. And Excel thinks to themselves, well, I have 15 other deals that I want to syndicate with Sequoia, right? Why am I going to sell them garbage? Why am I going to get them into this deal? What I'm going to do is I'm going to sacrifice your deal because it gives me credibility on the other 15 that are good. So what typically happens is VCs have a reputation as being sharks, dishonest. I think it's kind of the opposite. Internally amongst themselves, they are brutally honest. And now being an investor, I see this. So good example, I met with a company today, early this morning. I hung out with them, I liked them. I emailed 3 venture capitalists that I know. Guys, you've seen this deal, what do you think? What do you think? What do you think? Each of them wrote back a paragraph, it sucks for these reasons. And they're doing that because they want my angel syndicate to co-invest with them on their other deals. So I think that you have to understand the dynamics of the VCs to understand how you're going to get thrown under the bus. It's just, you're expendable now. You haven't hit your target. I'm going to invest in the next pretty girl who walks down the street who looks prettier than you. Any other questions? Good questions. Okay. Now we get into the super boring part of the conversation. Boring, I even put that on there. Okay, this stuff, I am not a professor. I am not a lawyer. But these are the terms that are going to matter, and they're freaking boring. So let's just go through them quickly. And the problem with this stuff is it is boring and it's detailed. And unless you have a great lawyer who's looking at this stuff and understands this game, you are going to get destroyed because you just are like, clause 17C of the shag. It's fine. But it's not fine. It's not good enough. It's going to kill you. On the topic of lawyers, there are some great lawyers in town. If you have not talked, and I'm going to give a shout out to Keith Spencer as an example at Fasken, is amazing. Steve Lucas, I think, did a presentation. Amazing. Those guys know their stuff. They are expensive, but they're willing to work with startups, and I do not work for them, nor do I get paid to represent them in a commercial basis. They are awesome. I've worked with them for 15 years. Okay, number 1 term is preferred shares or common shares. This is the one that drives a lot of these other ones, okay? Common share means there is one class of shares. And just to be clear, if there's any lawyers in the room, and I don't think there are, I am going to simplify this. For those people eating pizza in Nanaimo, I am going to simplify this. This is a nuanced conversation. I'm going to simplify it to go to the 80% rule, which is what's going to happen to you guys. Preferred share or common? Common share means cap table, 10 shares, 10 of us each own 1, okay? Company sells for $10, we each get $1, okay? Because we each put $1 in, if we're going to do that math. The way a preferred share works, typically, is I have a choice as to whether I want to get my money out first or I want to convert into common shares at the time of a liquidation, okay? This is really, really important. So you have a company, and I should have done this math on so you could see it. You have a company. I put $10 into your company, okay? You spent 5 years building it, 2 years before you ever talked to me. You raised $10 before you ever talked to me, okay? I don't care what the valuation is, but let's say the valuation was $20. So for $10, I own 1/3 of your business. Does everyone get that? Someone else owns 1/3 of your business, and you own 1/3 of your business, okay? I have my $10 in preferred shares. Company sells for $10. First angel gets nothing, you get nothing, I get $10, okay? That is the most common outcome for these early stage deals. And we talk about this all the time. Seniority, whether that's in debt or shares, is king. On the day that you get acquired, acqui-hired, whatever it is, the senior shares, and just to be clear, you can have one class of pref, which sit on top of another class of pref on another class. You could have 10 classes of pref, okay? And all of those preferred shares are going to have rights, and I'm not going to complicate the sort of the share structure here. I want to simplify it. Common, very friendly to the entrepreneur. Best case scenario for you. Preferred, think hard about that scenario, okay? I do deals in both. Why would I do a deal in common if I could do a deal in pref? The answer is I wouldn't. The reason I do common deals is because the entrepreneur has enough traction, big enough market, a good enough team, and other investors willing to take the deal at common for me to not do common, right? So it's all based on the competition in your deal. If you get a preferred share, you have to think to yourself, and there's actually a brilliant article written this week, I don't know if anyone saw it, on these unicorn companies in the States and what a waterfall of exit value looks like for those companies. You should check it out, do unicorn cap table valuation, essentially. And these companies that are going out and raising $100 million, $200 million at $1 billion unicorn-like valuation are raising preferred shares, right? So when those companies sell for $200 million, that entrepreneur gets nothing. Nothing. You have to think about that, okay? Now I'm going to put my investor hat on. I'm taking all the risk. I want my money back before you get your sweat equity back. Isn't that fair? I think it is. Is it fair? Yes. Is it? So I sit right on the fence on this. I feel like as an entrepreneur, I've never done a preferred share deal. As an investor, I have, because I can. That's the most important clause and negotiating point you can have in your first seed round. Any questions? I'm going to stop there. This is really important. We'll get you a mic. Yes.
Does the preferred versus common conversation change at all if the entrepreneur has self-funded? Like if I've self-funded 100K and then I've gone out to get 100K or 200K?
So does it change if you put your own cash, not just sweat equity, into the deal? And I'm going to say not fundamentally, but you might have more of an argument to make to either say, I want my 100 in pref too. You could try to make that argument, but the question's going to be, ultimately, if we were playing like African Bazaar and we're negotiating, well, if you don't need my money, put more of yours in. Uh-oh, I don't have more. Okay, you're going to take my terms. So it depends how much leverage you have. If you have 100K that you're willing to put into the deal, then that 100K can sit as a preferred share with the other investor. If you don't have leverage, the investor, and just to be clear, there are I'm going to put out 80% of the deals, 75% of the deals I see are common deals. So I don't want to scare you. Actually, what I want you to think of is, if that investor is asking for preferred, why? Is that something I want? Or I've got a valuation on the table which is $500,000 lower, but it's common. Should I do that? Yes, you should. Any other questions about this? Okay, I'm going to keep going. Liquidation preference. What the hell does that mean? People talk about this. This is something I have unbelievably seen in term sheets in the last year from certain VCs in town. If someone puts a liquidation preference on your deal, run for the hills. What does that mean? Remember we talked about that deal? $10 million in, we'll use the exact same example. I own a third of your business, your angel money is $10, you put in sweat equity, you own a third, right? What if I said to you, my $10, I want to get $30 back before anyone sees a penny? That's essentially what a liquidation preference is. I want 3x on my money before then we get back into the common share waterfall. This was very common in 2001 and 2002 when I started my first business. For some reason, I'm seeing it in the market. Anyone who throws a term sheet like that at you, run unbelievably quickly away. Do not take their money. And tell me about it, because I want to know who they are. Okay? Pro rata rights. What is a pro rata right? Pro rata right says, I put in $10, I own a third of your business. On your next round of funding, I want to have the choice at whatever valuation it is to put in my share of the money. Okay? Very common term, very acceptable term that gets abused. So let me tell you how it gets abused and how you should be worried about it. So pro rata, vanilla pro rata is reasonable and expected if you understand that my motivation as investor is to make 20 investments and follow on in 3, right? If you don't give me the ability to follow on into your deal, it wrecks my model. That doesn't work for me. I'm not going to put money into your deal. So don't be scared of pro rata. Be scared when someone says, I want a ratchet. I want to be able to, if your valuation is lower than it was on the day that we priced your deal, I want my pro rata just given to me. I want you to top me up to my percentage just because you were wrong about the valuation. In fact, I'm dealing with a company right now that's going through that scenario. So what happens in that scenario? Let me stop. Does everyone understand that scenario before I move on? Does anyone not understand it? This is really important. So basically the notion is I own a third of your business, okay? And you raise money from me at a $20 million pre-money valuation. I put $10, I'm using low numbers, $20 pre-money. I put $10 in, which now values the company at 30, okay? I own a third. What I'm saying to you is if you raise money at less than 30 on your next round, I get a third automatically for nothing. So let's pretend you raise at a $10 million valuation or $10 valuation. You missed your numbers, bad sales quarter, okay? You're just giving me a third of those shares for free. Question?
Sorry, is that pro rata or is that now ratchet that you just explained?
Ratchet is used in pro rata. So pro rata would be just vanilla, I get my piece. A ratchet is tied to that and says, I get my piece regardless of what the valuation is.
Okay, and the purpose is anti-dilution?
It's essentially anti-dilution. I'm protecting myself in any form of, and we're going to get into anti-dilution as well, but I like to look at it as pro rata because most investors will tie it together. I want my piece, and I want my piece at whatever valuation. This is uncommon too. If someone puts anti-dilution, ratchet, anything related to that, run for the hills and tell me who they are. That's not cool, especially early stage. Board seats. This is going to become really, really important to you guys, okay? So you have a company. Do all of you guys have a company? That's part of the deal, right? You have to. Does everyone have a company or coming? Okay. So you're going to create a BC or a Canadian corporation. That corporation has something called articles, okay? Articles of incorporation. Those articles talk about 70 different things that you can and can't do and the mechanics of how you do them. They are generic vanilla, okay? You are then likely, if you're using good legal counsel, going to sign a shareholders agreement. And what a shareholders agreement is, in its most simple term, is it takes those 70 articles and it changes 15 of them. Because it says for tech startups, I want to, for example, have this structure for my board. I want to have this structure if someone dies. I want to have this structure so that we can go to an arbitrator for valuation. I want this structure if we have someone who comes and buys us. There's like 15 things that we change all the time, kind of in the same way. And one of those really important things is the board. So, question, should an early stage seed investor get a board seat? Put up your hand if you think yes. Woo, you guys are tough. Okay. And I assume everyone else says no. Okay, so I actually am kind of mixed on this, and I'll tell you my opinion. So board seats are dangerous to give out because in your shareholders agreement, the board has a lot of power, okay? The board is going to say who gets hired and fired, who approves the budget, and a whole host of other things like options and other things that the board approves. you have to ask yourself the question, do you need more money and do you need to sell the deal up? If the answer is yes, it's really advantageous to get a high-profile angel leading you around on your board. Why? Because it shows a level of commitment into your business where it's not only their money they're putting in, it's their time. So my gut, and I sit on the other side of the fence now, is having a board seat, not a majority of your board, but a board seat with a respected angel in town who invested money in your company is a positive signal. I like it. I want to see that as an investor. Personally nice, personally good. Doesn't mean they control your board. It doesn't mean they can control your business, but it means you are collaborative. You are not dealing with founderitis, which many of us deal with, right? Founderitis means it's all about you and it's all about you building your business. If you want to build a big business, you'll have to invite other people to the table. So that was an interesting answer. I disagree. We talked about anti-dilution quickly. This is dangerous. Don't do it. We have not talked about protective provisions. This is something that we throw into deals all the time. Let me give you some examples. Famous angel in town. One of his famous angel protective provisions is the CEO shall not make more than $50,000 a year until the company's profitable. Okay? So what does that incent you to do? Become profitable, right? Many of you guys, especially in early stage SaaS, that's the worst thing you could possibly do. That's terrible advice. You want to get big and then get profitable, right? So the earlier you get profitable, the slower. The rule of 40 in SaaS is you got 40 points to play with. You can either play with growth or you can play with profitability. You can play with both, but you're not going bigger than 40, right? So if I'm growing at 40%, then I am growing at 40%. If I want 40% profit because I want to get paid more than 50K, I'm not growing. And I haven't seen, this is a pretty standard rule in the venture business, right? The rule of 40. So that's an example. Another example, hey, strong entrepreneur, we need to approve any expense over $5,000. Common, $10,000. Anything you spend on one ticket item above $10,000, we need to approve. What starts to happen? You start to become the government. You start to divide invoices into 9999, right? Again, why am I doing that? I'm trying to control you. I don't like that kind of provision. Is it reasonable to say you just raised $1 million and I don't want you to spend 100 grand without my approval? Yeah, that's probably reasonable, but 10 grand, come on. That could be a consulting fee, that could be a trade show, that could be some hardware. Another common protective provision. I get to fire the CEO. Common, all the time. I'm the major investor. If I don't like what you're doing, you're toast, you're dead. That's probably not a good plan, and I would not encourage that. One of the things you're going to see with VCs is they're going to have protective provisions that are 3 pages long. Literally. 3 pages of shit you can't do without their permission, or you need their permission to do explicitly. And I've seen this happen over and over and over again. Some on the VC are reasonable. If an angel starts putting protective provisions around your salary, how much money you can spend in basic terms, don't do it. Any questions on that? Okay, information rights. What information do I have a right to as an investor? What's reasonable? Okay, so you're a tiny little startup. You're all shitty at accounting. Okay, I guarantee it. Your accounting sucks. Your projections are terrible. And you're just not that organized. Okay, and nor should you be. I want you focused on business development, building your product. If you have wicked financials, I'm going to start saying, what the hell are you doing with your time? Why are your financials so good? Okay, is it reasonable for me as an investor to want a monthly financial update? Put your hand up if you think that's reasonable. 1, 2, 3. Okay. How about a quarterly update? A couple more. How about a yearly update? Okay. So I would agree with the majority. I think a quarterly update is great. Is a quarterly audited update great? God awful. Do not do that. Anything that's audited, whether it's yearly, monthly, or quarterly, is a massive waste of your time and money at this stage. Don't do audited. But quarterly financials are reasonable. What other information rights do people have? So here's a common one. Guys, I don't want to be in the board, but I want to attend the board meeting. I just want to be an observer, okay? That's a very common informational right. Don't worry, I probably won't show up. I wouldn't do that. As soon as they're in that room, they're privy to that information. As soon as they're privy to that information, you can't be hiding and spinning them. So there are many information rights that people are going to ask for. The most common is quarterly financial statements and the ability to come on premises with reasonable notice and audit this stuff myself. Totally reasonable. The reason I want that is I want to stop fraud as an investor. That's a reasonable request. At my expense, I'm going to bring my KPMG guys in with reasonable notice, and I'm going to look at your books because I'm worried you're cooking them. Will I ever do that? Unless it's war, probably not. Okay? 2 more, and then we're going to take a break. Drag along. What does that mean? So a drag along means 66 generally in a shag, 66.7% of the shareholders want to do something, and you're not going to stop us from it. Okay? So let me give you an example. We want to do this financing. Excel's at the table. It's awesome. We want to do it. We can drag other people to do it, to accept it. Most common drag along is an acquisition. This company's here to buy us. We own 66.7% of the shares. We say yes, you're saying yes. Really important clause for you guys as entrepreneurs, right? You will likely own the majority of your company for the first round of financing. You should own the majority of your company. And you need to be able to drag people along, okay? Right of first refusal and co-sale. What does that mean? It means someone can't go about and do their own thing as a shareholder, okay? So what that means is we both own shares, all 3 of us own shares. You can't just go out and sell your shares to some random dude on the street on the Lower East Side. I don't really want that dude being an investor in my business, right? You can't go and do a deal on the side. So what this essentially does is it covers side dealings, and it allows the company with a supermajority, generally 66.7%, to be able to block and co-sale in those scenarios. Okay? Again, typical, common shag terms that an angel investor is going to ask you for. There's one other term that's not on here that I think is really important that you guys are going to hear about, which is a shotgun clause. Has anyone heard of a shotgun clause? Okay. This one's interesting because I think it's actually really, really powerful early on, but no VC will accept it. Here's how it works. There's 2 of us, Bill and myself. We each own 50% of the business. We both sit on the board. That's all you need to know. We are killing it. I'm just going to use the positive example. We're doing really well, okay? But I hate Bill. I can't sit in the same room with the guy. He's an idiot. I do not want to be in business with him. Frankly, he feels the same way about me, okay? I'm arrogant. I'm a cocky, arrogant person. He doesn't want to be in business with me. What do? I can't be in the same room with him. It's poison. Our business is worth something. What do? So in that case, you're at loggerheads. You're screwed, actually, by the technical words of the law. You're screwed. You are at loggerheads. Each of you guys don't have enough of the business to do anything. You're essentially in legal limbo forever until you sue someone and they sue you for some, atrocious thing. Shotgun allows me to buy Bill out or Bill to buy me out. And what a shotgun does is it does the following. It puts 2 things. It puts time pressure and it puts price clarity on the table. So if I want to enact the shotgun, I say to Bill, I will buy your 50% of the shares for $1 million. Okay? Here it is, written down, Bill, 50%, $1 million. But, and here's the kicker, Bill can buy me out at the same price. Okay? So what that means is I just put an offer to buy Bill shares at the same time I put an offer for Bill to buy mine. So Bill can say, and generally time pressure is 14 days, maybe a month. Bill's got a month to decide if he wants to buy my shares or he wants me to buy his. In many cases, especially with a 2-founder team, it's the only way to get each other out. I have never, ever seen it used. I would love to see it used. It'd be like high drama. It'd be like a Western movie. I have threatened to use it, and it worked because I threatened. And the danger, let me just be clear, is if you have asymmetrical wealth amongst your founder group, might will win, generally, especially with a tight timeline. So if your co-founder's worth $10 million and you're worth 10, you're in deep shit, especially if your company's worth something. If it's kind of symmetrical, you guys kind of came out of school at the same time, neither of you are that wealthy, it's perfect. VCs will never accept it. Never. Take it off the table. Do not do it. I have had it in all of my shags for all of my businesses. And that's because if I don't want to go to war and I want to pre-describe what war is going to look like, and war is going to look like you put up a number and I'll buy you out for it, or I'll accept it and walk away. Any questions on that? Okay, a couple more slides, and then I'm going to give you guys a break. Valuation on debt versus equity. One of the things that comes up all the time is, should I raise debt? Should I raise convertible debt? Should I raise equity? My answer there is simple. What do you value? Do you value speed? Do you value control, cost, or valuation, or a combination of them? Depending on what you value, you will choose one or the other. Okay, and let me give you an example. Debt, meaning I don't price the equity, and what I'm thinking here is a convertible loan, which pays me back an interest rate and is converted at the next round of financing, is the most simple financing instrument to do. I don't have to value you. The only thing I need to do is value my discount and the cap. So what that means is I'm taking the risk. I want to, this is typical terms, a 15% discount, 10 to 15% discount on the next round, and I don't want the next round to be above a reasonable valuation. Typical valuation right now is $3 to $3.5 million. Okay, I give you $1 million. I want 8% interest on that. I want to be able to convert it at a 15% discount to a $3.5 million cap. Literally the easiest deal that's done, most common deal that's done in Canada today. I have been a part of 15 of them myself. BDC, led by Dom and Michael and Charles, are the ones who have put this typical term sheet together and this typical deal together. And they, I believe, don't quote me, have done about 150 in the last 2 or 3 years in Canada. This is the most common deal early stage startups take. Why do they take it? Because I don't have to talk about valuation, right? My legal costs are a fraction of what they would be if I did a real equity deal. I do it fast and I maintain all control, right? All that stuff we talked about, right of first refusal, protective provisions, all that stuff, it's debt. I treat it like debt until it converts. So it's super, super simple instrument. Question in the back.
With a convertible round like this, do those investors become shareholders, or are they just lenders?
They sit on your books as debt until they convert, at which point they're shareholders.
At the next round.
That's correct. So what I say by control is they're not shareholders. You don't have to answer to them. They're not shareholders. Question?
I'm right next to him. Thanks. So if I put money into my company,
Yep.
I've been told to hold it as debt on the outside of the company for this very reason, because if I bring other people on as partners, say, then we can convert that debt later and not have to figure out how much equity I have. Because right now, otherwise, I'd have 100%. Does that make sense to you?
So
and then I guess the follow-up question is, then I've heard other people say, well, when you get your first round of financing, you're going to have to, wipe those debts clean. You're not going to be able to pass those debts on to your next, to the next set of investors. They don't want to hold debt.
So first, answer to the first question is, I'm assuming in your question you have asymmetrical wealth on your founding team and you're the one anteing up the money. Okay, essentially, let's just pretend that's the question. Or someone's anteing up money and some people aren't. What do? Right? In that case, debt's a great instrument because you don't want to price it. You don't want to price it because it's an internal round and no one cares what your pricing is anyway. So in other words, I'm going to price my 50K at 10 million. It doesn't work. I don't care. And so debt is a really nice instrument and convert at the next round. In terms of wiping the debt clean, that's dumb. No. Why would I wipe my debt clean? My money isn't my money I was going to say green, that's American money, but like blue and purple and whatever, brown, ugly brown. Like my money's as good as yours. Why am I wiping my debt clean? No. What you would argue is it comes in at discount to the valuation, and where you'd probably end up is I'll just put it in at the valuation. So wiping debt clean, that's weird. No, I wouldn't do that. Money is money. Yes?
Have you seen the SAFE make its way up north? I've always been uncomfortable with the notion of having a technically insolvent company.
Yeah, so we just did a SAFE deal. I just did one of my backgrounds is I was executive director at Grow Lab, and we created Highline, which is accelerator. I'm on the board of that group, and Highline is doing a SAFE. So we just did a deal, I don't know, with Coho, where Highline did a SAFE into Coho. A SAFE is essentially convertible debt, but it's slightly different in a couple of very technical ways, which I'm not going to get into in the discussion we're going to have today. Yes, I've done a SAFE. I know of 5 to 8 people who have done a SAFE. And if you want to look up what a SAFE is, Google Y Combinator SAFE. They're the ones who came up with it. 500 startups and Techstars have their own version that they have cool little acronyms for too. But what it does is it's essentially answering these same questions. They deal with valuation a little bit more in the SAFE. Costs are cheap, speed is super fast, and the same thing, they're not actually on your cap table as a shareholder, but you essentially owe them, there's money that's owed. I'm not worried about the insolvency side. I would be more worried about what that cap is. Just like any convertible debt, what is the cap and what's the conversion mechanism? Maybe I'll explain that just super quickly, right? So imagine that you do $1 million of convertible note, right? You want the convertible note to convert at the next round. You don't want it to wait. The reason you don't want it to wait is because it has a cap and a discount to the cap. This sometimes happens on the SAFE documents, right? So let's pretend the trigger for a convertible note to trigger into debt, or into equity, I should say, is a $500,000 raise. What happens if you only do a $200,000 raise, and then you kill it, and you raise $5 million 2 years from now at 20? Well, that guy just got to sit earning an 8% clip on their money and convert at 3.5. Best deal ever. So when you think of convertible, you want to convert as early as you can because there's a cap, right? The other thing you want to think about, and this comes up all the time, is what does that cap do for me psychologically as I go to get my next round? Okay, so I am a debt holder. I own $1 million of debt at a $3.5 million cap. You, sir, are at Excel, and you're going to put money in at 6? You're a savvy investor. Why am I putting money at 6? It's capped at 3.5. Your number's 3.5. So you get into the scenario where that cap is a psychological barrier to your next round, which is, again, why if you do have a cap, you want to do it as early as possible. In some respects, if you're really early, the cap is powerful because it anchors that round higher than it should be. If you wait too long, your value's higher, and the valuation's going to go down because you're anchored at a cap. Does that all make sense? Okay. Any other questions about debt versus equity? Okay, we are going to take a 5-minute break. I want to talk about, this is the really exciting part of the presentation. Did I have boring up there? No, just other thoughts. Okay, so I've got about 5 other thoughts, then I have 3 nice visual slides, and then we're going to go right into questions. Okay, these are the most common things that people ask me, so I'm going to try to preempt some of the questions. How much should I raise? How much money should I raise? Very, very common question. The answer is very simple, in my opinion. It's 12 to 18 months of runway. That's it. Don't overcomplicate it. 12 to 18 months of runway in your medium business case. Don't go too conservative, okay? That's how much money you should raise. Is it bad to oversubscribe my round? No, it's awesome to oversubscribe your round. You want to oversubscribe your round. We just did a round for a company that we are associated with. We went out to raise $450, we raised $950. What does that signal? That's a hot company, I want to be a part of it. Good. Oversubscribing is great. Are bridge rounds bad? What is a bridge round? A bridge round means you promised your early stage investors You would hit certain milestones with the money you gave them. You did not hit those milestones. You need more money. You have to do an internal bridge round, or the worst is an external bridge round to get there. That's not a good signal. Bridge rounds are not good signals, which is why you should raise 18 months of capital to begin with, because you're going to miss your deliverables. You're not going to be as good as you think. Your hockey stick's going to look less like a hockey stick, more like a skipping rope, like a limp one. And people talk about the J curve all the time. I think it's more like an S curve. So you're going to miss your financials. I don't believe it. That your financials, just to be clear, you're going to miss them. Raise a lot of money to start with because you're going to miss them. Don't do a bridge round if you can help it. What about accelerators? Are accelerators good? Should I join an accelerator? I am biased. I founded a Canadian accelerator called Highline. I was an executive director of Grow Lab. I think here's my advice, unless you have a killer team, unless you have an awesome early stage advisor or investor, an accelerator is the only way to get noticed. So why is an accelerator good? One reason is they give you fast capital. Second reason, in Canada, especially if you went into Highline, which is my accelerator of choice, BDC is there behind you with $200,000 or $150,000 convertible note, and it gets you noticed. So yes, if you can get into a good accelerator, get into one. They're great. How much of my own money should I put into this deal? We just had a question in the break about that. So there is a spectrum here. I want to see that you have skin in the game, but I also want to see that you're not a fool, okay, as an investor. Many of you guys are fools. And what I mean by that is you think it's cool to come to me and say, this is like, how many of you guys watch Dragon's Den, right? The worst part of Dragon's Den, the part that I cringe at, is that old dude that walks on the thing with the shittiest family-oriented game and says, I put my net worth into it, all of it. Well, you're just a total idiot, okay? And we're all laughing at you, and we're kind of, my wife's, because she's really nice, she's crying, I'm laughing. And she's like, and you're an idiot. So don't be an idiot. Don't be that guy on Dragon's Den or that woman on Dragon's Den that comes up and says, it's all my net worth. I remortgaged my house. I went into debt. If you have family, you're an idiot. If you're solo, you have rich parents, maybe you're smart, just don't over leverage yourself for your startup, okay? Don't pretend to yourself, don't bamboozle yourself to thinking that just because you're putting your money into it, that it's smart. The cardinal rule of investing is you need other people at the dance. Why? Because they have to validate that you're not an idiot, okay? If no one else is willing to put money in and you're the only one, you're an idiot. It's really, really simple. If you're the only one that's put money into your startup today, up to this point, ask yourself a very powerful question, which is, why am I the only one in the world willing to fund this? When is your money really useful? It's really useful in the earliest stages of your startup. Why? Because that's when your valuation is the lowest. So you're an investor too. Why would I put money in early? Because it's the lowest valuation. I get the biggest chunk of the business by putting my money in super early, okay? This is something that just gets really sad to see. I had an entrepreneur on my deck 3 days ago. He's got 2 kids. He should have stopped 6 months ago. He's dead. He's dead. And he knows it, and he's up to his eyeballs in credit card debt, and that's just sad. Don't do that to yourself. Don't take that risk. It's not worth it. That pain for your family is not worth it. The pain for you is not worth it. Okay, due diligence. What am I going to due diligence around this capital raising that's really important? The most important part is I'm just going to give you a really basic logic test. That's it. The reason I'm doing diligence, actually let me back up. The reason you went to university was to learn how to write. I'm firmly believe that that's the only reason you went to university, to learn how to write and to learn how to think. The same thing, and it's awesome. Lots of degrees are awesome. When I give you a test, the only thing I'm thinking about is the logic. I don't care what the answer is. How did you get to, had a conversation today, why are you raising $1 million? Give me the logic. Okay, let's see if that logic falls down somewhere. How well have you thought it through? You said your total addressable market's this. Tell me the logic behind it. Explain that to me. As someone, especially in that first meeting, the only thing I'm trying to do is test your logic. That's it. I don't care about the numbers. I'm frankly probably never going to diligence them because I don't believe them anyways. What's the logic? Well, we are going to be a $20 million company. Why is it that you only have 2 sales guys? Because each of them are going to make $10 million. Show me an example of a sales guy in SaaS selling $49 a month SaaS that's made $10 million. Give me one. It doesn't exist. So where did that come from? You fall down in your logic. It's not the answer that's important because your answer is wrong. I'm going to repeat that again. Your answer's wrong. Everything you tell me about where your business is going to be in 3 years, it's wrong. I've never seen it right. So why are you the first business in the history of the world that's going to tell me something that's right? It's all about the logic. And the reason the logic is important is because all these dynamics are going to change in your business, and I want to see how you're going to handle that because I know you're going to change. Okay. I'm going to go on to 3 more slides, and then we're going to take questions. Number 1, people really suck at intros. Okay? To get a pipeline of investors, you need to make introductions. How do you do it? Okay? What you don't do is you don't call me and you don't email me cold. I'm not interested in that. I get 250 email a day. You email me, you go to my junk pile. What do? You find someone who I respect, and you get them to intro you to me. And that's the same logic as any other investor. So don't go cold. Hey, I have 28 emails in my LinkedIn right now that say, Dear Jonathan, I am an entrepreneur based in fill in the blank. I have a wonderful product. You want to invest in my product. I want to take 5 minutes of your time and go through it. I will never get back to you, ever. I promise you, I'll never get back to you, and most investors won't. That's not the way the game is played. The game is played when Lance says, hey, I got this cool guy I went for coffee with. This guy's interesting. Meet him. Boris does the same thing, and we do that reciprocally. Don't play a game that you're going to lose. Don't give me a business plan. Don't send me a PowerPoint. Don't do it cold, because you're not going to win. Okay? 2, what I really want to see is a competitive person. If I was going to say what the number 1 trait of successful entrepreneurs is they are unbelievably competitive. So what does that mean? How do you display competitive nature, right? You are here to win. You are here to take my money and build a tree that grows more money. You need to display competitiveness. What is that? How do you demonstrate that to an investor? So what you do is you show me that you give me a goal and you overachieve. I say this all the time, but investors don't invest on dots, they invest on lines. This is from my friend Mike Edwards. I can't pretend I came up with it. What a dot means is I'm never going to invest you on the first meeting. What I'm going to say is, what's your goal? What's your short-term 1-month goal? And you're going to tell me, and I'm going to write it down, and I'm going to meet with you in a month if I'm interested, and I'm going to say, how did you do last month? And you need to show me that you crushed it. So what do? You sandbag the goal, guys, right? Sandbag it. The best entrepreneurs are the ones who have already achieved the goal. Next month, I'm going to do 30 new sales. You know you just did 35. Like, let's be honest about how this game is played. If you come to me and say you have 30 sales to do, your historical is 5, is the best month you've ever had, and you have to come to me and show me 30. Don't do that, right? So think about how you're going to present to me or to any investor, because I'm drawing a line, and hopefully that line is, wow, that person overachieved this month. What's your goal next month? Holy shit, the goal is better this month. We said 15% compound monthly growth, you hit 20. You're a superstar. Wow, next month you hit 22. That's awesome. So don't think for a moment that a savvy investor is going to invest in you on the first meeting. They're going to say, what's your goal? And you have to show that you are super competitive. Another thing you got to show is that you are unbelievably independent. And what I mean by that is entrepreneurship, the game you guys are playing, is a lonely, lonely game. There is nothing worse than sitting there, not knowing what to do, failing, and trying to come up with a plan. I've been there, it sucks. You need to show that you are able to take that and independently make, something good out of a whole stinking pile of shit. That's really your job. Because it's going to be brutal sometimes. It probably already is for some of you guys. And I need to see someone who's independent. Here's another really interesting one, because introverts, geeks, how many of you guys are geeks? How many of you guys are introverts? Okay? We, and I'm going to put myself in that category, get maligned. So I am an introvert, but I can play the game. So one of the things I look for, I love introverts that can play the game. Why do I love introverts that can play the game? Because those people are not naturally getting energy from the meeting that they're having, and so they are putting themselves out there, and it's a manipulative situation, right? When I'm sitting and talking to you guys, and I'm going to field as many questions as I can tonight, I'm not an extrovert. For those people who know me, not many in the audience do, I'm not someone who's like naturally gregarious. I don't go to parties. I'm a loser. Like, I'm a serious loser. But I play the game. I can play the game as well as anyone else, but I'm playing for a reason. And what I want someone to do is to take my money and play the game for a reason. Don't play the game because you just want to go and meet cool, hot girls or hot boys. That's not interesting to me. That's not going to multiply my money. I want you to play the game for a reason. So all those introverts out there, all those geeks, you rule. I like you. Okay, 2 more and then we're done. I really want capital efficient businesses. And most investors are. This is the like hot thing. How can you be capital efficient? If you have not demonstrated to me you have been capital efficient, i.e., yeah, we decided not to go with Amazon, so we decided to build a web server. Okay, you're an idiot and you're not capital efficient. So lean is another example of this. People talk about all the time. Be super lean. And this is an ageist comment that I'm going to make, but if you are 40 years and above, don't play the game that you were playing the last 15. It ain't going to work. The game today is lean methodology, fail fast, cohorts, testing, data-driven. Understand those worlds, because that's the world we all live in. And if you don't know what your CAC is or your LTV over CAC, you are in trouble playing this game with savvy people who know how to play the game. Don't tell me you have a 2-year build and a 3-year product launch with a trade show product launch. I'm not going to take you seriously. I'm going to walk you out of the room. Okay, actually, I'm going to go for one more slide. So everything I said tonight was around business. I'm going to give you one more piece of information that I actually like to give at every presentation, which is the following. When I am 95 years old, when all of you are 95 years old and you're sitting in the old age home, you're not going to remember this presentation. You certainly aren't going to remember this presentation. You won't remember this presentation tomorrow morning, likely. You are not going to remember the name of your first business or your second or your third, and you're not going to be counting the money that you have in the bank. That is not actually important. The thing that's important in your life is family. So you need to be a great husband, a great father, a great wife, a great daughter, a great girlfriend, a great boyfriend. Because if you aren't those things, your life's going to suck. And one of the things that all entrepreneurs think is that it's really cool to drink coffee at Revolver, to have an ironic haircut, and to work 18 hours a day. And as a father of 3 children, happily married for 12 years, 13 years, that's not cool. That's sad. Okay? So don't think you have to be this tough guy, tough girl entrepreneur that works all the time to make your life happy, because it's the exact opposite. I have a lot of people I know with a lot of money. Those people are the most unhappy people from a cohort perspective that I can tell you. They have the highest rate of divorce, and they're unhappy. Why do you want to be that person? So the last thing I'm going to leave you with is have passions in your life outside your business. That makes you an interesting person. That makes you someone I want to hang out on a desert island with for 5 days or 7 days, and it makes you happy. So everything you hear and talk about in new ventures and in business in general is going to focus on winning, being the best business person. Don't take that as the only thing that's important in life. The most important thing, by 25x multiple, 100x, 1000x is family. So go home tonight. If there's anything you can think of or remember about this conversation, is go to someone you love and ask them how you can be a better person in that relationship. So if you have kids, it's the most powerful question. Ask your kid, how can I be a better dad or a better mom? And try to get better there, which is going to inevitably lead you to become better in your life. And I cannot stress this enough. People don't get it. They don't see the forest from the trees. And the only thing that makes you happy in life is family and love and friends. And it's not any of this crap. With that, I'm going to leave you with a thanks slide and questions. So we have about 25 minutes of questions. What I like to do is I like to take any question. If there's something that's really confidential, I like to have, we'll turn off the camera for those people finishing their pizza in Nanaimo, and we are going to have like startup confidential. If you have a very important question that you're happy to share with the group that will not be online, and you can ask that question, I'm happy to answer. If there are no questions, that's cool too. But I'm going to stop there. Is there any questions generally that have come up tonight that I can answer? Let's go in the back first. And we'll just wait for the mic to ask and answer. Thank you.
Hey, thanks. Here's one about early stage in the team. So I'm the visionary founder. I kind of came into this thinking about how to raise money, how to grow. My latest inspiration is that maybe I should be focusing on growing the team and starting this whole process with a real executive level team versus trying to do it myself and with interns or whatever. And what do you think is where does the visionary founder start to bring in visionary partners and start that trade-off of, this is my baby versus this is our baby?
Yeah, good question. So I think I'm going to give you a depends answer, and it depends on the type of business. So I would look at it and say, the more important question for me is what am I really good at and what do I like to do? And then I would get teammates to help out with those other core competencies. So if you are a visionary founder and you're the technical guy, and that's what you love, and the notion of going to raise money makes you vomit in your mouth, don't go raise money. You're not going to do well with that. So then you want to bring in a business person, right? If you are in a healthcare business, as an example, you want someone with healthcare expertise. If you're in clean tech business, get some clean tech expertise. I do not think, and many investors will say this, that you need this well-rounded 4-person team to go to market. I don't believe that for a second. I believe some of those people are going to be employees and some of those people are going to be founders. I am wary of single founder teams. Reason, there's no bus, like the bus factor is you. And frankly, if you get hit by a bus, my investment goes down. I'm not interested in that. I'm not going to do that probably. So single founder teams, people don't like. Do you need like 5 people and sing Kumbaya and have socialism? No, you don't need that either. Some people say, I don't say this, 3 people is the ideal founding team. Why? Because you can vote 1 person off the island. Any other, question?
Jonathan, what is, or what would be an ideal startup for you as an investor in which you would invest without any second thought? Just some basic parameters, just describe it. And have you ever met something like that?
So what is my ideal startup, and have I ever met anyone?
Ideal startup, yeah.
So I have met 18 in the last 18 months, yes. My ideal startup is, let me back up. So the way I'm going to answer this question is the way that you should ask it, which is, what is the parameters of my funds? I have 2 funds. I have 3 funds, actually. One of my funds is I invest in, it's called Oak Mason. I invest in international entrepreneurs, and I bring them to Canada through Startup Visa. Okay? Stage agnostic. I'll bring big companies, I'll bring small companies. Second fund, Stanley Park Ventures. I create companies with my ideas, our ideas, our money, and we bring the team together. Third fund that I invest in, I'm obviously ADD because I have too many things to do, is I invest in my AngelList syndicate into deals that are seed to institutional seed. Traction, ideally revenue traction, and we hit the $600,000 to $1.2 million number per investment, and we don't lead. So those are the three entities that I invest out of, and unless you fit one of those 3 criteria, I'm not a good fit as an investor. But I have found 18 companies I liked in the last number of years. And hopefully some of the stuff I told you today about market, team, traction are the things that I look for, and frankly, every other investor does. Question, yes, hi.
Going back to your introduction question, as a person who gets a lot of attention, a lot of emails, if you get an introduction from someone you know, do you usually follow up on that, or do you expect the entrepreneur to come back and say, this is
awesome
glorious?
Question. You win question of the night so far. That is an awesome question. Okay, so I actually just went through this yesterday. So the short answer is I'm not going to do very much work. I'm going to do the least amount of work I possibly can to schedule a meeting with you, and I want you to do the work, okay? But, so what's really common today is these calendaring things. Click on this button and book a meeting with me. So I was booking a meeting with an entrepreneur, and I don't really read my email. I'm not very good at that stuff. And she sent me this thing. I'm not clicking on it. I'm not going to go through my calendar to sync with her calendar, as an example. So what I do is I play this terrible, inefficient game of email tag until I have enough people backed up that I do my own calendaring bullshit. So what I do is I'll get like 10 or 12 people backed up that I haven't met with for 6 weeks. Then I'll send them all an email because they're all in my inbox, and I'll say, if you want to meet with me, click on my link. That's the way I do it. There are other people. Boris Wirtz is a great example. German, hardcore. You email him. 4 minutes later, he emails you back. He books you with his assistant if he wants to meet with you. I'm not very efficient. That said, I just put a job offer out today for an executive assistant that's going to change my life. So if that change of life happens, then I'm going to be like Boris. Like Boris has 4-minute turnaround time. I'm going to be like 2. But so I don't want to do any work. In fact, I'm going to add one more thing. If I kind of don't really want to meet with you, I'm going to test your competitiveness and kind of ignore you. Not in a mean way, but I want to see how much you want to meet. And if you keep persisting, I'll meet with you. Yeah.
How badly do you want to win this Twitter competition?
How badly do I win the Twitter competition?
Yeah,
well, I'm killing them. So I'm destroying them. I'm really, really competitive. I want to win it. So did you follow me on Twitter? Okay, I'll answer your question then. I want to win it badly, yes. Next. Thank you for your support. I appreciate that.
Just a note, if you really want to win a Twitter competition, you should have a hashtag.
Yeah, that's a good point. Thank you.
Yes. And then on to my real question.
Okay.
Yes. What is the ideal amount of valuation, like for a startup that's getting valuation? What is the valuation that they should be pursuing? I'm assuming that if you're too low, nobody's gonna want to acquire you. If you're too high, then they're gonna require a big exit. So
got it. So
what's the sweet spot?
Okay, so the answer is another depends question. Where are you in your startup? So do you, SaaS-based, do you have a team that I would recognize? Yes or no? So there's a couple ways to do it. There's the throw the dart at the wall way, which is the way I like to do it, which is throw something out and see what sticks. Or there's the Angel Forum checklist way to do it. And then there's the ridiculous asinine never do discounted cash flow analysis because that's stupid. So don't do that. So one or the other. I think the natural evolution of the startup market in Vancouver would say your company's worth between 2 and 3.5. And so where are you in that scale? I'm looking at you, I'd say 2.5. You're worth 2.5. Start there and see what happens. But no, you don't want to go and say I'm 500. Then you look like an idiot. So the parameters that I'm giving you are a general range. I was in Bulgaria 2 weeks ago. I was doing a keynote presentation at a conference there, and someone asked me that same question. I threw it out and said, guys, what's your number? Their number, 6 to 750. 600,000 to 750. So we have like a developed world premium. We have a Vancouver developed world premium that we put on top of it. Silicon Valley, 6, 8, 2.5, 2 to 3.5. Other questions? Yes, Daniel. Let's get you, Mike.
If you're looking to do like a $3 million round, should you just head to the Valley, or is that something that happens here?
So it is something that happens. My second startup, we raised 11, the largest angel round in Canadian history with nothing. That was some of our money and some angels. It happens more commonly than you think. And then it comes back again to how big is this deal, how big is the market. And in that case, I didn't talk about this, it's what appetite does your lead have to take a big ass chunk of that money. So my math is your lead should be at about a third. So you need someone who's willing to write you $1 million check to have a chance at 3, probably more like 1.2, 1.5. And there are maybe 10 guys in town that write checks that big. So your chances are low. There are hundreds of people in the Valley that write checks that big. So it's just a matter of supply and demand. Once you go and talk to those 10 guys, and I'm not going to tell you who they are, or else I'm going to get killed because you're going to talk to them all, you are out of luck. You're not going to the Angel Forum and raising $3 million in a day. So if you haven't talked to those 10 guys, figure out who they are. That's the first test, and then talk to them, and then see. That's how I would play it. Doubtful today, yeah. Any other questions? More, yes, sir, with the fine blue coat that I like.
Okay, so my question is about the second way that you mentioned that you can fund with, which you get the idea, you get the money, or your company do this, and then you choose the team to build this.
Yes.
So how much equity you think is good for this team? Because like you get the idea and the money, right? And they have they will put the sweat in it and try to make it happen.
Yeah.
So how much equity they should expect and how they can apply for this as well?
Great. So the answer to that is we want to give away between 40 and 50% of the business. That is separated amongst the founding team. We believe, and let me give you an example of our first project, which was Coho. I don't know if you guys have heard of it, but it's a bank. It's the bank that you guys need to sign up for because it's going to be game changing. It's basically a bank that actually satisfies you. And the background is the banks in Canada aren't satisfied until you're not satisfied. I'll let that sink in. And this bank is actually customer service driven. So millennial focus, check out Coho. Dan's going to be really excited I said that. Follow them, sign up for their pilot. So the answer is we have an open application for entrepreneurs. We look at entrepreneurs on a constant basis. Our mandate is to do 4 deals a year. We have funded 4 so far. We're into year 2. We are looking open invite. If you think you're an entrepreneur that could meet our requirements, go to stanleyparkventures.com, read our blog at reversevest.com, and get intro to me somehow. Yeah, but we think it's fair, given that we're putting up all the money, our ideas, that the team essentially gets 40 to 50%. There's another question there.
Hi, Jonathan.
Hi.
You've mentioned that angels would like to reduce their risks. What are the ways that they generally like to reduce their risks so that they're not out when things go bad?
The number one is preferred to common. So the number one risk that you see as an angel is I want my money out before you get yours. That's by far and away the most prevalent way to reduce risk, because just that one decision cascades down to 15 other things that they just reduce their risk on. That's by far the most common. Sorry for the pun, common, but it's the most common. Yeah. Yeah, question?
How important is it for you that for entrepreneurs that they have a vision of an exit strategy in place?
Well, I will answer the question facetiously to say that I'm putting my money in you to get a return. So if you never exit, it's very unlikely, unless you promise me some massive dividend, which I don't believe, that I'm going to get a return. I don't like someone explicitly saying in a slide, here's who I'm going to sell to, because I don't believe companies are sold. I believe they're bought. And so the logic would have to hold that you have to actually create a product that someone cares about with a customer that's willing to pay for someone to care to buy you. So I focus on the latter things, because unless you accomplish those three things, and you can do it on paper profitably, then no one will ever buy you. So for me, it's inherent in the devil's bargain that we make when I put money in you, that I'm going to get a bunch of it back with a bunch more money tied on top of it. You need to exit to do that. Could be an IPO, unlikely. It's probably going to be a trade sale and a typical acquisition. You don't have to spell it out for me. That's what I would say. Any more questions on camera? Okay, awesome. So feel free to follow me on Twitter. Did I say that already? We have a blog, which is called reversevest.com. I think it's actually a really interesting, honest perspective on a lot of the topics we talked about. And I want to thank you guys all for your time.